If you are completely new to trading, this video is for you. Not if you want fast money, not if you want excitement, not if you want a shortcut. This is for people who want to understand what trading actually is before losing money trying to guess. Let me start by saying something very clearly. Trading is not a job. Trading is not passive income. Trading is not guaranteed. Trading is a probability business. And if you do not understand that sentence, everything else will feel confusing. Most beginners fail because they start trading with the wrong expectations. They think trading is about being right. It is not. They think trading is about predicting price. It is not. They think trading is about finding the perfect strategy. It is not. Trading is about managing risk while operating in uncertainty. That is the core. Now let me tell you what trading is not. Trading is not buying when price goes up and selling when price goes down. That sounds simple, but it is not how professionals think. Trading is not copying trades from someone else. That removes responsibility, and responsibility is required to survive. Trading is not about indicators telling you what to do. Indicators only show past information. Markets move based on orders, not indicators. Now let us talk about what trading actually is. At its simplest level, trading is the exchange of risk between participants. Every time you enter a trade, someone else is taking the opposite side. One of you will be wrong. Professionals understand this. Beginners try to avoid it. That is why beginners search for certainty, and professionals focus on structure. Now here is something important. You do not need to trade every day. You do not need to trade every market. You do not need to trade every opportunity. Most of trading is not trading. It is waiting, and waiting is uncomfortable for beginners. Now let me be honest with you. If your goal is to turn a small account into a large account quickly, trading will punish you. If your goal is to learn how markets behave and protect capital first, trading will teach you. Survival comes before profit, always. Now let us talk about time. Trading is not something you finish learning. Markets change. Conditions change. You adapt. Anyone promising mastery in weeks is selling entertainment, not education. In 2026, markets are faster, information is everywhere, and attention is short. Your edge is not speed. Your edge is clarity. And clarity starts with removing false beliefs. Here is a belief you need to remove right now. You need to be smart to trade. No, you need to be disciplined. There are very intelligent people who lose money consistently because intelligence does not equal control. Now let me set your expectations properly. In the beginning, your job is not to make money. Your job is to lose small. Small losses teach you structure. Big losses teach you pain. Professionals learned through controlled losses. Beginners try to skip that phase. That is why accounts disappear. By the end of this video, you will not have a magic strategy. You will have something better, a realistic understanding of what trading demands and whether this path even makes sense for you. That alone will save you money. In the next part, we are going to break down how markets actually move in the simplest way possible. No jargon, no hype, just the mechanics every beginner must understand before placing their first trade. Do not skip it. This is where confusion starts to clear. Before you ever place a trade, you need to understand one thing. Markets do not move because of indicators. Markets do not move because of opinions. Markets move because of orders. Everything else is noise. Let us strip this down to basics. Every market exists for one reason, to match buyers and sellers. That is it. When more people want to buy than sell, price moves up. When more people want to sell than buy, price moves down. Simple. But here is where beginners get confused. Price does not move smoothly based on fairness. It moves based on liquidity. Liquidity means availability of orders. Large players cannot trade the way beginners do. They cannot just click buy or sell and move on. They need large numbers of orders on the other side, and those orders usually come from retail traders. Now let us talk about the two types of orders that matter: market orders and limit orders. Market orders mean, I want in right now. These orders move price. Limit orders mean, I am willing to buy or sell at a specific price. These orders sit and wait. Price moves when market orders consume limit orders. That interaction is the entire market. Now here is something very important. Most retail traders use market orders. They buy breakouts. They sell breakdowns. They place stop losses. All of these are market orders. That means retail traders provide liquidity. Professionals consume it. This is not manipulation. This is structure. Now let us talk about why price spikes. Have you ever seen price suddenly move fast, hit stops, then reverse? That happens because stop losses are market orders. When many stops sit in one place, price is attracted there. Not emotionally, Mechanically, this is why obvious highs and lows matter. Above highs, there are buy stops. Below lows, there are sell stops. Those stops are fuel. Now let us talk about trends. Beginners think trends happen randomly. They do not. Trends happen when one side is forced to exit. When sellers are trapped, they buy back. When buyers are trapped, they sell out. Forced exits create momentum. Momentum creates trends. This is why markets often move fastest after trapping people. Now here is where beginners mess up. They ask, will price go up or down? Professionals ask, where are people wrong? That is a completely different question. Price moves to areas where orders exist, not to areas that feel logical. Now let us talk about time frames. Price is fractal. That means the same behavior exists on all time frames. 1 minute chart and daily chart follow the same rules. The difference is noise. Lower time frames have more noise. Higher time frames have more structure. Beginners start too low. Professionals start high and zoom in only for execution. Now let us talk about news. News does not move markets by itself. News is a trigger, not a cause. If liquidity already exists, news accelerates movement. If liquidity does not exist, news does nothing. This is why sometimes big news causes small moves, and small news causes big moves. The market was already positioned. Now let me correct another misconception. The market is not trying to be fair. It is trying to be efficient. Efficiency means clearing orders with the least resistance. That often feels unfair to beginners. But it is predictable once you understand behavior. Now let us summarize this part clearly. Markets move because of orders. Orders cluster around obvious levels. Price moves to clear those orders. Trapped traders create momentum. That is the foundation. If you understand this, indicators stop feeling magical. They become secondary. Now here is your beginner mindset shift. Your job is not to predict price. Your job is to observe where liquidity exists and how price reacts around it. Reaction matters more than prediction. In the next part, we are going to talk about the different markets you can trade in 2026. Stocks, Forex, crypto. Which ones make sense for beginners and which ones you should stay away from. This decision alone can save you years of frustration. Do not skip it. Now that you understand how markets actually move, we need to answer a very practical question. What market should you trade in 2026? As a complete beginner, this decision matters more than most people realize. Many beginners fail, not because they are bad traders, but because they choose the wrong market for their experience level. So let us go through this carefully. There are 3 major markets most beginners look at: stocks, Forex, crypto. Each one behaves differently. Each one has advantages and risks, and not all of them are beginner-friendly. Let us start with stocks. The stock market is where most people begin. Stocks represent ownership in companies. They trade during specific hours. They are regulated, and information is widely available. For beginners, this structure is helpful. Stocks move slower than crypto. They are less leveraged by default, and you can choose to trade or invest. However, stocks also have challenges. Some stocks move very slowly. Some require larger capital to feel meaningful, and earnings news can cause sudden gaps. As a beginner, stocks are best approached carefully. Swing trading stocks or learning on higher time frames is usually safer than fast day trading. Now let us talk about Forex. Forex is the foreign exchange market. Currencies traded against each other. This market runs almost 24 hours a day. It is extremely liquid, and it allows small accounts to participate. This is why many beginners are attracted to Forex. But here's the reality. Forex is heavily leveraged. Leverage amplifies both gains and losses. Used correctly, it provides flexibility. Used incorrectly, it destroys accounts. Forex also moves quietly. It does not always respect obvious patterns in the way beginners expect. However, for traders focused on structure, liquidity, and risk control, Forex can be very efficient. The key word is control. Forex rewards discipline. It punishes impatience. Now let us talk about crypto. Crypto is the most misunderstood market. It moves fast. It is emotional. It is heavily influenced by sentiment. This makes it exciting and dangerous. Crypto is not beginner-friendly. If you are chasing speed, prices can move violently without warning. Leverage is easily available, and regulation is inconsistent. Many beginners blow accounts in crypto, not because crypto is bad, but because they approach it without structure. If you are a beginner, crypto should be treated carefully. Higher time frames, small size, no emotional attachment. Now here's the most important truth. The market does not matter as much as how you trade it. A disciplined trader can survive in any market. An undisciplined trader will lose in all of them. So what should a complete beginner do in 2026? Start simple. Pick one market, not three, not everything. One market allows you to understand behavior deeply. Switching markets too often resets learning. Now let me give you clear guidance. If you want structure and regulation, stocks are a good place to learn. If you want flexibility and liquidity, Forex can work with strict risk control. If you want volatility, crypto should be approached slowly and respectfully. What you should avoid as a beginner are things like excessive leverage, multiple markets at once, constant strategy hopping. Now let us talk about something else beginners ask. How much money do I need? Less than you think, but more patience than you expect. Your first goal is not to grow money, it is to learn behavior. Small accounts teach discipline. Large accounts expose mistakes. That is why starting small is not a disadvantage, it is protection. Now let me say something very important. You do not need to trade every day. Markets will be here tomorrow, and the next year, and the year after that. Missing trades is not a problem. Blowing an account is. In the next part, we are going to talk about the only skills that actually matter in trading. Not tools, not indicators, skills that apply to every market and every year. This is where beginners usually get distracted. Do not skip it. Up to this point, we have talked about what trading is, how markets move, and which market to choose. Now we need to talk about what actually makes someone survive. Not strategies, not indicators, not secret setups, skills. Most beginners focus on the wrong things. They search for tools instead of learning skills, and tools change. Skills do not. There are 4 core skills every trader must develop. If even one of these is missing, consistency becomes impossible. Let us start with the first one, time frame awareness. Most beginners trade too fast. They start on the 1-minute chart, then the 5-minute chart, then they panic. Lower time frames move quickly. They create emotional pressure. Professionals start higher, daily, 4 hour, 1 hour. Higher time frames show structure. Lower time frames show noise. This does not mean lower time frames are bad. It means beginners should not start there. Your job is to understand what the market is doing overall before worrying about entries. Direction comes first, precision comes later. Now let us talk about the second skill, understanding structure. Structure is how price moves from one point to another. Higher highs, lower lows, ranges, breaks. You do not need fancy terminology. You need to answer simple questions. Is price trending or ranging? Is momentum strong or weak? Is price expanding or consolidating? Most beginner mistakes happen when they trade against structure. They try to buy in downtrends. They try to sell in uptrends. Not because they are wrong, but because they are early. Being early feels smart. Being aligned is profitable. Now let us talk about the third skill, risk management. This is where most beginners fail. They think risk management is something you add later. It is not. Risk management comes first, before entry, before profit, before confidence. Every trade should answer one question. How much am I willing to lose if I am wrong? If you cannot answer that, you should not be in the trade. Professionals think in percentages. Beginners think in money. Percentages protect you. Money triggers emotion. Risk should be boring, predictable, consistent. If your risk changes every trade, your results will be random. Now the fourth skill, the most difficult one, patience. Patience is not waiting. Patience is choosing not to act when conditions are not met. Most beginners feel pressure to trade. They think activity equals progress. It does not. Trading rewards selectivity. One good trade is better than 10 random ones. Professionals wait for price to come to them. Beginners chase price because waiting feels uncomfortable. But discomfort is part of the process. Now let us address something important. You do not need to master everything at once. In the beginning, your only goal is consistency, consistent process, consistent risk, consistent execution. Results come later. Now let me remove another myth. You need to be confident to trade. No, you need to be prepared. Confidence grows from repetition, not motivation. Now let us talk about indicators briefly. Indicators are not evil, but they are not primary. They should support understanding, not replace it. If you rely on indicators to tell you what to do, you are outsourcing thinking. That is dangerous. Now let us summarize this part clearly. The skills that matter are time frame awareness, structure understanding, risk management, patience. If you build these skills, strategies become secondary. Without these skills, no strategy will save you. In the next part, we are going to bring this together into a simple beginner trading plan. Not a strategy, a plan. Something you can actually follow. without guessing. This is where most beginners finally feel grounded. Do not skip it. Up to now, you understand what trading is, how markets move, which market to choose, and which skills matter. Now we need to do something important. We need to remove randomness. That is what a trading plan does. A trading plan is not a strategy. It is a decision filter. It tells you when to trade, when not to trade, and how much to risk. Without a plan, every trade feels emotional. With a plan, trading becomes mechanical. Now let us build a simple beginner trading plan. Not perfect, not advanced, just functional. We start with the first rule. Rule 1, define when you trade. You do not trade all day. Pick a specific session. For example, New York session, London session, or a specific 2 to 3 hour window. Why? Because focus matters. Trading all day leads to overtrading. Overtrading leads to mistakes. Professionals limit exposure. Beginners increase it. You want the opposite. Now rule 2, define what you trade. One market, one instrument. Not 10 charts, not everything moving. If you trade stocks, pick a small watch list. If you trade Forex, pick 1 or 2 pairs. If you trade crypto, pick one major asset. Depth beats variety. Now rule 3, define your time frame. This is critical. As a beginner, your primary time frame should not be lower than 15 minutes. 1 hour is better. Lower time frames increase noise. Noise increases emotion. You want clarity, not excitement. Now rule 4, define your risk per trade. This is non-negotiable. Your risk should be a fixed percentage. For beginners, that is usually small, very small. You are not here to get rich yet. You are here to survive. If one loss hurts emotionally, your risk is too high. Professionals can take losses calmly because risk is controlled. Now rule 5, define what makes a setup valid. This is where most beginners overcomplicate. You do not need 10 conditions. You need clarity. For example, is the market trending or ranging? Is price near a key level? Is structure aligned? If you cannot explain why you are taking a trade in one clear sentence, do not take it. Now rule 6, define your exit before entry. Every trade needs 2 exits. Where you are wrong, where you take profit, not in the moment, before entry. Deciding exits during a trade is emotional trading. Professionals plan exits first. Now rule 7, limit the number of trades per day. This is protection. 1 to 3 trades is enough for beginners. More trades do not mean more progress. They mean more exposure to mistakes. Quality beats quantity. Now let us talk about something important. Your plan does not need to be perfect. It needs to be consistent. You will adjust it over time. But without a starting structure, there is nothing to adjust. Now let me say something clearly. A trading plan will feel restrictive at first. That is good. Restriction creates discipline. Discipline creates consistency. Freedom comes later. Now let us talk about journaling briefly. Your plan is useless if you do not review it. After every session, ask 3 questions. Did I follow my rules? Did I respect risk? Did I trade emotionally? Do not focus on profit or loss. Focus on execution. Money is a side effect. Now here is the biggest beginner mistake. Changing the plan after a few losses. Losses are part of trading. Your job is not to avoid losses. Your job is to avoid chaos. Consistency requires repetition. Now let us summarize this part. A beginner trading plan includes defined time, defined market, defined time frame, defined risk, defined rules, defined limits. That is it. Simple does not mean easy. It means clear. In the next part, we are going to talk about psychology, losses, and why most beginners quit. This is the part that decides who stays and who disappears. Do not skip it. At this point, most beginners think the hard part is over. They understand markets. They have a plan. They know what to do. And yet, this is exactly where most people still fail. Not because of strategy, not because of intelligence, but because of psychology under pressure. Let me say this clearly. Trading psychology is not about being calm. It is about being prepared for discomfort. Losses will happen. Drawdowns will happen. Confusion will happen. If you are not prepared for that, no plan will save you. Now let us talk about the first psychological trap, the need to be right. Beginners want validation. They want the market to confirm that they are smart. So when a trade goes against them, they hold longer than planned. They move stops. They delay exits, not because they believe in the trade, but because they fear being wrong. Professionals accept being wrong quickly. Beginners fight it. That difference is expensive. Now the second trap, revenge trading. A loss feels personal, so beginners try to win it back immediately. They increase size, they lower standards. They take trades they normally would skip. This turns one small loss into a large one. Professionals step away after emotional losses. Beginners lean in. Now the third trap, overconfidence after wins. This one is dangerous because it feels good. After a few winning trades, beginners feel in sync with the market. They take more trades, they loosen rules. They assume momentum will continue. The market does not care how you feel. Professionals do not change behavior based on short-term results. They trust process, not streaks. Now let us talk about losses properly. Losses are not failure. They are feedback. A loss only becomes a problem when it breaks discipline. Professionals measure success by rule following. Beginners measure success by profit alone. That is why beginners feel emotional, even on winning days. Now here is a critical mindset shift. You are not trading to win today. You are trading to still be here in 6 months. Survival is success. If you survive, skill has time to develop. If you blow up, learning resets to zero. Now let us talk about drawdowns. Drawdowns are normal. Every trader experiences them. What matters is how you respond. Beginners panic. They change strategies. They increase risk to recover faster. Professionals reduce activity. They protect capital. They stay consistent. Drawdowns are not the time to be aggressive. They are the time to be precise. Now let me talk about something uncomfortable. Most beginners quit trading, not because they lost money, but because they lost confidence. They start doubting everything, their plan, their ability, their future. This happens when expectations are unrealistic. If you expect fast success, normal losses feel like failure. If you expect a long process, losses feel manageable. Expectation management is psychological protection. Now here is something important. You cannot eliminate emotion from trading, but you can contain it. Rules contain emotion. Limits contain emotion. Routine contains emotion. Relying on willpower does not work. Willpower runs out. Systems do not. Now let us summarize this part clearly. Beginners blow accounts because they need to be right. Revenge trade. Overtrade after wins. Change plans under pressure. Professionals survive because they accept losses, follow rules, limit exposure, think long term. This is not talent. This is behavior. In the final part of this guide, we are going to talk about what to do in your first 90 days of trading. A realistic roadmap. What to focus on, what to ignore. This is where everything comes together. Do not skip it. If you have watched this entire guide, you are already doing something most beginners never do. You slowed down. That matters more than you think. Now let us talk about what your first 90 days in trading should actually look like. Not what social media shows, not what marketers promise. Reality. The first 90 days are not about making money. They are about building behavior. If you miss this phase, everything later becomes harder. Now let us break this down simply. Days 1 to 30. During the first month, you are not a trader. You are a student. Your job is not execution. Your job is observation. You should be doing 3 things. First, watching price, not predicting, not forcing trades, just watching how price moves around highs, lows, and ranges. Second, learning your platform, entries, exits, position size, no confusion during live conditions. Third, keeping risk extremely small, so small that losses do not affect you emotionally. If you feel stress, your size is too big. During the first 30 days, profit does not matter. Understanding does. Days 31 to 60. This is where most people rush. Do not. This phase is about controlled execution. You should now have one market, one time frame, one simple plan. Your goal here is consistency, not performance. Take fewer trades. Follow rules strictly. Journal everything. Not just outcomes, decisions. Ask yourself after every session, did I follow my plan? Did I respect risk? Did I trade out of boredom? This phase will feel boring. That is a good sign. Boredom usually means discipline. Days 61 to 90. Now things start to feel clearer. Not easier, clearer. You begin to recognize patterns. You begin to trust your rules. This is where patience is tested. Do not increase risk yet. Do not expand markets yet. Your job here is to prove that your behavior is stable. If you can follow rules, for 90 days, you are ahead of most people. Now let me say something important. Your first year in trading is not about income. It is about survival and skill. Anyone selling fast success is selling fantasy. Professionals think in years, not weeks. Now here is the final truth. Trading is not about talent. It is about alignment. Alignment between your expectations, your behavior, your risk, your patience. If even one of these is off, results become unstable. Now let me be very honest with you. Trading will not change your life overnight, but it can change how you think. It teaches patience, responsibility, self-control, and those skills compound far beyond markets. Now let us talk about information. What you consume matters. If you jump between strategies, opinions, and personalities, you will stay confused. Clarity requires consistency. This channel exists to provide that clarity, not signals, not hype, structure, process, long-term thinking. If this guide helped you understand trading in a calmer, clearer way, staying connected makes sense, not because you owe anything, but because repetition builds understanding. Now let me close this properly. Trading does not reward urgency, it rewards patience. It does not reward hope. It rewards preparation, and it does not reward emotion. It rewards discipline. If you are willing to slow down, respect risk, and think long-term, trading can become simple. Not easy, simple. That is the difference.